Good afternoon, Kelly. Good to see you.
Is it a good thing that fundamentals, because some are saying we're going to get earnings declines this year. I think even Jamie Dimon talked about that yesterday.
Yeah, I think we're in this period that I call a worry window after you've seen a significant market bottom, but there's still a lot of concerns about hard data that's set to come and the lagged impact on earnings, which definitely are still uncertain. But as you and Steve just touched on, the uncertainty levels have fallen pretty sharply. And so that's why the market's rebounded as much as it has in the last several weeks. And that's why correlations in the market have also collapsed. You know, at the depths of the market, stocks were trading at like a 70% correlation. Things were really moving together. And in recent weeks, that's dropped down to about 19% or so. So it's much better for stock pickers as there's more differentiation ahead.
Although you say that's kind of if rates stay where they are. You don't want to see the 10-year going back up towards 475.
Yeah, I think, in terms of looking ahead, what could be a problem or a headwind for markets, it's whether, inflation fears and interest rates accelerate sharply or growth fears return and unemployment increases sharply. I don't think either are going to increase sharply, and it'll be continue. We're going to continue to see things, I think, rather stable. And I think the economy overall is going to be able to get through this period of uncertainty.
You guys always are super tactical in your recommendations. So, sectors and styles and, individual names, if you have them, what do you like? What don't you like?
Yeah, so generally, we still have high interest rates, high price levels, concerns around inflation and growth. And so the way I see it is we have tariffs now, and we're kind of back to this bifurcated economic theme. At the extremes, you've got housing on one side and AI on the other side and everything else in between. So we've generally continued to prefer companies that have done well leading into this backdrop. Those that are generally larger, have better economies of scale, better profitability, lower interest expense costs, and that are more profitable. So this quality theme, which I've been talking about on your show over the last couple of years ad nauseum, I think is going to continue. And I think we're kind of in a secular period of quality leadership because we're in a unprecedented bifurcation in the economy. Cyclically speaking, we're going to see better soft data. So I think the financials, industrials, and technology sectors should outperform. Defensive sectors, healthcare staples, utilities, and interest rate sensitives like real estate and housing, I think will continue to lag.
Yeah, that's a little bit, I don't want to say it's opposite, but we talked to James Chuckmuck yesterday, who's dialed up the defensive part of his defense and growth portfolio. And, so what you're saying goes a little bit against kind of what he's doing, which I just find interesting.
Yeah, well, I guess, again, for the market to go back down, we need either another policy shock, an inflation shock, a growth shock. And I think we've been shocked enough so far this year. So I think we're going back to a backdrop in the economy where parts are doing really well and other parts are not doing well. And that's been the backdrop really since 2022. And I think it persists. Yeah,
you guys, and tell me, you have the ETF. That's kind of what this does. It doesn't do quality picking on the small cap space, LITL. So it's not little like the grocery store. It's LITL. I think we have to go, Michael, but a quick final comment.
Yeah, we partnered with Simplify and launched the Simplified Piper Sandler small cap ETF, which utilizes our macro outlook and our quantitative views.
Yeah.
And I think this is a great backdrop for small cap quality stocks, which is what we're currently focused on in that portfolio.